Hello guys, my name is Alex Katsaros and I'm the product manager of CTrader. In this video series I'm going to teach you the basic and advanced concepts of forex trading, so after you watch the whole series you will learn how to trade and think like a professional trader. Here at Spotware, the company behind CTrader, we get compensated from your volume. That's the reason we made this educational series, because we want to help you learn how to trade more successfully so you can grow your accounts. In this first video I'm going to teach you everything you need to know about the basic of forex trading. You're going to learn what forex exchange is, what a pip is, how to go long, how to go short, and what you're supposed to do when you begin your forex journey. So let's get started. Forex means foreign exchange. Foreign exchange means to change your currency for another country's currency. For example, if you want to visit a foreign country for vacation, you go to your local bank and you're changing your currency for notes of the country that you're visiting. When you're doing that, you're actually doing a foreign exchange transaction. The foreign exchange market is the greatest market in the world. It has a daily volume of around $4 trillion. The main participants of the foreign exchange market are global banks and their customers. People exchange money for any reason, like commercial companies exchanging money for hedging or for their commercial activities, or people exchange money if they want to travel or for any other reason. However, when you're using CTrader, which is a trading platform, you're obviously not using it to exchange money for your vacation. What we're doing when using a trading platform is we're doing something called speculation. The trading platform shows us the exchange rates between two currencies, and what we're doing is we're trying to speculate if the exchange rate is going to rise or it's going to fall. And then we're trading, do the necessary trade, and if our speculation is correct, we win money. If our speculation is wrong, we lose money. Let's go to CTrader and I'm going to show you exactly what I mean. You see here on the left, we show the market watch. The market watch shows you all the currency pairs that are available for trading. Let's look closely to the first and most famous pair, the euro versus dollar. Let's open the information window. Every forex pair displays two currencies. Euro versus dollar means Euro USD means euro versus dollars. The first currency is called the base currency, and the second currency is called the quote currency. The exchange rate shows you how many units of quote currency you can buy with 1 unit of base currency. In this example, the exchange rate is 137.735, so 1 euro can buy $1.377. However, for every currency pair, we see two exchange rates, as you can see here. Why is that? The reason for that is that the way banks and brokers make money from the customers who trade forex. They will buy a currency from you at a slightly lower price, and they will sell a currency to you in a slightly higher price, and that's make the difference between the rate to buy and the rate to sell. The difference between the price to buy and sell in a currency pair is called the spread. We can see the spread here in Market Watch for Euro USD, it's 0.9 pips. I'm going to explain to you what pips are in a bit. Okay, so you learned what forex is, and we learned what the exchange rate is and what the spread is. So what are we supposed to do now in order to make money? In the middle of the screen here, we see the Euro USD chart. The chart shows us the current exchange rate and the past exchange rate of the symbol. The reason is that we need the past exchange rate is because traders use a technique called technical analysis, which helps them speculate on the future exchange rate using the information that we see from the past of the chart. We also use various tools like the tools we see here on Line Stanley's toolbar. In order to understand more about technical analysis, you can see videos 2 and 8 of the series. The basics of forex trading are rather simple. You see the exchange rate between two currencies on your chart, and if you believe that the exchange rate is going to go up, like here the chart is going to go up, then you buy the currency pair. If you believe that the exchange rate is going to go down, if you believe that this chart is going to continue going down, then you sell the currency pair. The chart goes up if the base currency is gaining strength, and the chart goes down if the quote currency is gaining strength. There are two conveniently placed quick trade buttons in the top of the chart that do exactly that. Pressing the buy button here, after you select the volume that you want to select, I'm going to show you how to select your volume in a bit, will buy the currency pair. So if we click the button, I see here I have a position, I have bought the currency pair. You buy the currency pair on the exchange rate above the buy button, which is called the ask price, and it's represented on the chart by the blue line. If you believe that the exchange rate is going to go down, you share the currency pair by using the sell button with the exchange rate above the sell button, and you sell on the red price, which is called the bid price. Those two prices together are called the spot price. If you are correct in your speculation, you will make a profit. If you are wrong, you will make a loss. Remember, we said you need to select your trade volume. So how exactly are you going to do that? Why are the numbers in the drop down here so big, even though my account balance is very small in comparison? It's just 11,000. The reason for that is that Forex is a leveraged financial product. That means that you control a bigger amount of money than the money in your account balance in order to make profits faster. For more information on leverage, you can watch episode 6 of the series. If leverage didn't exist, you would make money very slowly unless your account balance was very big. So which one of these volumes should you choose? The volume of your trade depends on how much of your account balance you want to risk with your trade, how much money you want to make, in combination with how much you expect the exchange rate to move in order for you to win or lose those amounts. This sounds a bit complicated, but it really isn't. Let me show you an example using two different volumes. First, we select 100K volume and we buy at this rate. We believe that the exchange rate is going to go up, so we move that little TP or take profit box to the place that we believe that the exchange rate is going to go. So what is that box? This is called the take profit, and it means that when the price reaches that rate, your position will close and you will get the money. You must remember that in order to make money when trading, you need two trades, one that opens a position and one that trade that closes a position and gives you the money. Of course, things don't always go your way, so there is the opposite box that is called a stop loss. You move this box to the exchange rate that you believe is the lowest you can afford to lose. Here we're using a volume of 100,000. Let's look at the numbers more closely now. So let's move our stop loss here, and let's move our take profit here. We're using a volume of 100K, and we see that we're going to lose 222 euro, and we're going to win 224 euro. Now let's close this position, and let's open the same position with 1 million volume. And let's put our stop loss and take profit on exactly the same places. Now we see that we're going to lose 2,236 euros and we're going to win 2,214 euros. That's because the volume now is a lot bigger because it's 1 million and the previous volume was 100,000. That's the effect of trade volume in your trading, and that's why it's important to select the correct volume when you're creating an order. In risk management, which is the episode 6, we explain exactly how much you must be risking with each one of your trades. Okay, so how do you calculate the volume that you're supposed to be trading with? Let's close this position here. In order to calculate the volume, you need to understand the concept of a pip. So what is a pip? The concept of a pip confuses many novice traders. The pip digit is the fourth decimal digit in all symbols beside yen symbols, and the second decimal digit in all symbols that have yen as their quote currency. So why do traders use pip? Why don't they talk about money? As I talked about before, you see that every trade has a different stop loss, a different take profit, and different volume. So if one trader will say to another that he made 1,000 euros from a trade, that doesn't mean that the trade was a good trade or a bad trade or a mediocre trade. However, if the trader will say to another trader that he made 50 pips from a trade, the other trader can understand exactly how much of the exchange rate the first trader got for his own benefit. So let's go to CTrader, where I'm going to show you using an example how what exactly I meant with a pip. So let's create a new order here with 100,000. It's a buy order. We see that the exchange rate that we have entered, the entry rate, is 1.37703. Let's put our take profit at exactly 137,803. If we subtract the entry price from our take profit, we're going to see that the difference is 0.0010. So that means that the difference is 10 pips. You see here it says pips 10. And the reason is that, like we said before, the pip is the fourth decimal digit, and that means that 1 pip equals to 0.0001. So 0.0010 means 10 pips. We said before that the spread between Euro USD here is here it's 1 pip. So that's what 1 pip means. It means that the difference between the ask and the bid price is going to be 1 in the fourth decimal digit. So great, now we know what a pip is. But how will that help us calculate our order's volume? In Forex, the volume you select depends on how much money you want to make or risk and how much pip you expect to win or lose. So by knowing or calculating the profit per pip for each volume, you know how much volume you should choose. The profit per pip for 1 pip of Euro USD with a trade volume of 10,000, as we see here on the combo box, is standard and it's 1 USD. By knowing that, you can understand how much profit per pip you can make with any volume. If you trade 20,000 Euro USD, the profit per pip is 2 USD. If you trade 100,000 Euro USD, it's 10 USD. And if you trade 1 million Euro USD, it's 100 USD, and so on. When trading Forex, the volume that you select is always a volume of base currency, and your profit or loss per pip is expressed in quote currency. Let's use another example. Let's use USD Swiss franc. Let's open a new chart here. So, if we trade 10,000 here, we trade 10,000 USD, and our profit per 10,000 USD is 1 Swiss franc. In CTrader, your profit and loss here is conveniently expressed always in your account's currency, so the profits are converted and you understand exactly how much you win or lose. Now that we have this information, let's try again. My account is 10,000 USD and I want to risk $100. However, I want to make a profit of $200. I believe the exchange rate is going to go 100 pips low and I want to risk 100 pips. Based on the information I have given you already, you know that if I want to risk 100 USD with 100 pips, I want to risk 1 USD per pip. We already know that the trade volume that risks 1 USD per pip is 10,000 because I explained that before. So let's select 10,000. Let's put first, let's create the order. So we have our entry rate here. So now we're going to put our risk. Our stop loss is at 100 pips because remember we wanted to risk 100 pips. So I'm going to move here this stop loss until I see the pips here say 100. And you see where it says 100 pips, I'm risking exactly $100 like I wanted to. Now we said that we want to make $200, so let's move the take profit to 200 pips, where this number says 200, and we're going to make exactly $200. So now you know exactly how to create an order and how much volume you're supposed to choose. And you also know what a stop loss and a take profit is. You can create an order from the quick trade buttons, or you can create an order using the order screen, which is the icon is found here and the symbol that you want to trade. After your order is filled, a position appears in TradeWatch, as we've seen before. You also see your position in the chart. In the end of your position, you see your account currency, how much your position is winning or losing at any given time. Remember that you will not add this number or subtract this number to your balance until your position is closed, either by a stop loss or a take profit. But if you want to close your position at any time before it reaches those levels, you can close it using the close button. So if I click the close button now, it's going to close this position. And that position had a loss of 3 euros, so I took the loss in my balance. The quick trade button creates a market order. A market order means that you will request to buy a specific volume, but you will not send to the server a specific rate. You want to request this volume to the best possible price. The exchange rate that you're going to get that is shown above your buy or sell button is not guaranteed when creating a market order. You will get the best exchange rate at the moment the order reaches your server. If you want a guaranteed exchange rate, you can use a limit order. Let's go to CTrader when I'm going to show you exactly how to create a limit order. You can create a limit order by right-clicking at the rate you want in the chart. So if I want to create a limit order in this rate, I can right-click and select Sell Limit. So if I want to do a sell limit on this level, I'm going to press Sell. And you can also preset your stop loss and take profit, like we shown before with the market order. If you want to trade a market order, when the exchange rate reaches the specific price that you have chosen in the future, you use a stop order. You can right click and select Sell Stop, do the same thing, sell. Now we're using a stop order. Again, preset stop loss and take profit. You can also create a limit and stop order using the order screen. You can just select limit or stop order. You can create a limit order on the best prices, better prices at the current market price. So if I want to buy here and I want to create a limit order, I can create a limit order from here, which is a spot price, as we explained before, and below. If I want to create an order that's going to be a worse price, then I'm going to use a stop order, and it's going to be from the exchange rate, from the spot price, and above. The reason why this is happening is because we want to protect you. If you want to create a limit order so you request this specific rate, which is a worse rate than the current spot price, so you're buying higher, we want to protect you because someone might give you this rate and you're going to lose money for the reason. So let's quickly go through the platform so that you understand the rest of the tools. In the right here, you see the line studies toolbar, and this helps you trade using lines, trend lines, support and resistance lines, and other tools. You can check out the video Support, Resistance and Trend Line Trading for more information. It's a very popular trading method. On the top right, you see your CTrader settings, where you can set a lot of things like your application layout and your quick trade settings and other stuff. Inside the chart, you see the chart controls, when you do where you add your technical indicators, or you can select your time frame for your chart. You can check episode 11 of multiple time frame analysis to understand what a time frame is. In this video, I explained to you the basics of Forex trading, so by now you know what the spread is, what a pip is, you know how to go long, how to go short. You also know what to do in order to make money, how to enter an order, and how to choose your volume. This may be the basics of Forex trading, but this is what you'll actually be doing all the time, because that's what trading is. You buy and you sell and you create orders, and then you close your positions. However, in order to be successful in your trading and in order to make money, you need to be correct when you're speculating. That's the reason why the series does not end here. In the rest of the videos, you're going to learn how to have a correct trading system, how to use technical analysis in order to speculate the market correctly. You're also going to know correct Forex risk management, how much you're supposed to risk and how much you're supposed to win with each trade. In the next video, we're going to talk about technical and fundamental analysis. In the following videos, we're going to talk about risk management, trading psychology, specific technical analysis tools, multiple time frame trading, and a lot of advanced concepts. So if you like this video, don't forget to subscribe, and if you want, share it with your friends. Thanks for watching.